Hello, everyone, and welcome to another episode of the Wealth Tech Insider. I'm your host, Danni and Grande, and very happy to be joined by my co-host, Peter Warren, for this, I'm going to say, newsflash today, Pete, and Snap podcast. How you doing?
Yeah, thanks, Danny. I remember a couple of years ago, if I sprung a Snap podcast news on you, you would have gone, nah, I need a few days to prepare for this. What? How times change.
I'm just so confident now.
When you're a professional podcaster, you're just ready to go, man.
That's right.
Even last week, we're on the road. I was changing things on the fly. You were fine with it. This is good, Danny. It's good.
Yeah, no, I'm just learning to not sweat the small stuff.
Yeah.
All right. So we do have a little bit of news today that we wanted to talk through. Actually, I need you to talk me through this, Pete.
Sure.
Vanguard signed a definitive deal to acquire Altruist. I think this is an AI forward self-clearing custody and tech platform for US independent advisors.
Yeah.
Yeah.
Yeah. I mean, so Altruist is a business I've been following pretty closely, probably for the last 18 months. They sort of came on the map. They were one of those sort of challenger. When I say challenger, I mean like a challenger brand. They're sort of startup. They were a startup. They're about 10 years old now. And they were really trying to take on the really entrenched US custody providers in the US like Fidelity and Schwab and those businesses where, unlike Australia, there's sort of been probably three key players in that US wrap business market. And so there's been some challenges come along. But Altruist is probably the first one to really made a real dent in their, as a startup. And I suppose they've been particularly successful in the RIA, or what we would call the IFA market over there, in getting a lot of traction. And I guess they really came on my radar. I don't really follow the custody platforms too close in the US, but they definitely came on my radar when they acquired an AI sort of note taker, for lack of a better term, about 3 years ago. And they've actually since converted that into a product called Hazel, which is both still a note taker, but they've also built a pretty sophisticated cash flow modeling solution. Yeah, and it's clearly becoming an advice tech platform that bolts straight onto the custody wrap. So that's when they came onto my radar about 18 months ago. Yeah.
Interesting. And so obviously this is all happening in America at the moment. What's been the reaction over there with advisors and the market over there?
Really interesting. So I've only really scanned, kind of LinkedIn and a couple of Reddit forums this morning. So the news only broke overnight. So just so everyone's clear, Vanguard are acquiring Altruist for about $4 billion. So that's about a doubling what it was valued about a year ago when they last raised capital. So that's good for them. And put it in perspective, $4 billion US is about the equivalent of the market caps of Harbour Net Wealth. So it's not insignificant amounts of money, albeit, I look with envy on those valuations in the US market. They're just always much higher than what we get here. But there's probably two elements to this deal, I suppose. One is, Altruist being acquired. So I think their founder has a pretty strong personality. He's a good marketer. He's on LinkedIn even more than I am, and sort of promoting his business, and he's done a really good job of that. And I suppose because they really played this independence card pretty hard, there's sort of this probably a bit of backlash starting to happen. But I think the more interesting tale for me is the acquirer, which is Vanguard, who don't really have a huge track record in acquiring businesses that buy little bits and pieces, but this is a pretty deliberate move into the wrap business for Vanguard. And I think that's what's causing a lot of the sort of ruminations from the US, because Vanguard actually sold out of their wrap business about 10 years ago, I think that was, and now they're getting back in.
Did they already own a slice of Altruist or not?
I'm not sure. So Altruist had other investors in there. So they were, a startup. They'd raised plenty of capital from other businesses. They did have a stake. Sorry, yes, I should confirm that. They did have a minority interest. So probably shouldn't come as a huge shock that decided to strike. But I think the questions on the US market is, so what a lot of people don't understand here in Australia particularly is that in the US, you work with a wrap business and you tend to be pretty monogamous with that wrap business. The reason being is you don't have any real fiduciary best interest duty to sort of, you can pick your player and you go with them. So that's one thing. But the other element is that the wrap businesses, the custody platform, they refer a lot of business to IFAs. So they get a lot of direct investors that come to them. And a big part of the appeal is, well, you come to us and we'll refer you. All the people in this postcode will make sure you're on our list of people that they refer to. So you can imagine in Australia if there was a world where, let's say, an IFA got half of its leads, if not more, from their wrap platform. You can imagine the dynamics would be so different.
It's so different, isn't it, to the way we work over here?
Yeah. Yeah. And there's no sort of dealer group level, and it's really different. So I think the concern in the US is channel conflict. So Vanguard, unlike Australia, Vanguard have a very large advice business, personal advice business called Personal Advice Services that has some ridiculous, a million customers or something crazy like that. So they are perceived as a potential competitor to the typical IFA, albeit they probably only serve the mass affluent market, but Vanguard's also known for getting a lot of high net worth investors that just want index, right? And so a lot of, I think, Altruist customers are saying, well, we partner with you because, you weren't competing with us and we pay. So you can imagine, this is probably where the rub is coming. So
bit of a conflict brewing.
Potentially, yeah. I mean, everyone's always going to say, "Well, how does this impact me?" I mean, I've seen that's one extreme. On the other extreme, I've seen a lot of posts because Altruist, from what I've observed, is a really well loved product. It's a bit like Hub and Net Wealth. They've serviced the hell out of their advisors here, and so they're well liked. All the net promoter scores, and even the way when they acquired what was Time, which is a note taker, and they've turned it into Hazel, which is something a whole lot more, and really bolted it to the front of the custody platform. And advisors love that. They love
so it is.
tech.
So it is actually working. That AI solution is actually working really well.
It seems to be. Yeah. And there's a real need for that market because you can imagine every state in America has different set of tax rules, and so these tax engines are pretty valuable over there, probably more valuable than here. But obviously, people increasingly see, like we've predicted, people do see their custody platform as a logical provider of advice tech for them.
Yeah, okay. And so they sort of go all in on that for their advice tech needs? Is that what you mean?
I think they are, and I think that's going to keep happening. So the reality is that some of the custody platforms have said, no, we're going to let the equivalent X plans and all those people do what they do, where Altruist said, well, actually, that's fine. We'll have integrations and those things. But you know what? We think we can do some stuff pretty well on this front that just works well with our data. And so they basically integrated the advice tech very closely to the custody platform. And I suppose in a world where if you're an advice firm, you've got 100% of your business with one platform, kind of makes sense. I mean,
why wouldn't you do that?
Yeah. And it's not, they don't make it free. Like there's definitely, I mean, maybe they do, but you can still buy the advice tech separately or the wrap or either or. You don't have to buy all of it, but I would imagine they do some pretty preferential good pricing deals for those businesses that buy both, obviously. Okay. But I suppose it does tie to the sort of the whole idea of that the proposition that if all the data's there and I can advise and implement trades from that advice directly onto my custody platform and the data's live synced and it's all accurate and I'm not worrying about data feeds, I can understand how compelling that is.
Yeah, I mean, I guess it's the same here though, right? Like if I was all in on Hub24 or Net Wealth with my clients, they've got great reporting. Everything kind of happens and all of their functionality is only getting kind of better over time as well. Yeah. Why wouldn't you? You wouldn't necessarily need, depending on how your business ran,
Particularly for the smaller firms, like the 1-2 person operations who are all in. That makes complete sense. I think like a lot of our consulting clients who are, bigger advice businesses and have complexity and money everywhere, it's probably a different reality. But I think the key things for interest in me are Vanguard making a big move. And I think what Vanguard in Australia does versus the US are going to be quite different. They're quite different businesses, but it does show that company's appetite to own advisor tech is an interesting one. And Vanguard are probably not known for being fast moving and innovative, but they're bloody customer centric. You can't argue with that. And those are how they run their model. And so I think and I think the other threat is where Altruist was sort of this startup player. And whilst we think a $4 billion company is pretty big here, it's pretty small relative to the other players there. Now they're owned by this, I don't know what Vanguard's FUM is now. It's in the many trillions, right? That's a serious threat to Schwab and Fidelity.
So you think that Schwab and Fidelity would be losing sleep over this, or is it just rounding out?
I would be. Yeah. Well, those other two businesses are publicly listed, I'm pretty sure. Vanguard's effectively mutual, so it's as close to a not-for-profit as you get. That's kind of threatening, right?
Yeah.
So, I mean, this is the kind of stuff I love, right? Just trying to anticipate where the market heads and what does the US, what are things over there happen. But if I draw it back to some local things that happened, so in the last 7 days, we've had all of our big wealth players release their full year results and present to their investors. We're obviously close to Hub24, as everyone knows, so we've sort of been across what's happening there. But they've been pretty public about their MyHub strategy now, and there's been a lot of stuff in there in the investor decks with what they're trying to do, which is, I would say, less about close we're building at all, more about creating better quality data connections with tech. And I think that's why we're pretty supportive of that. Net Wealth yesterday had their full year results, or the day before, I can't remember, I'm losing track. But they actually spoke a lot about advice tech yesterday. So I'd encourage people to listen to that call and look at that presentation where, Matt was talking a lot about that advisor efficiency is a big piece of the puzzle for them, which sort of makes sense, because once you cap out your growth, you then start looking at, well, we've got to make our customers more efficient to keep growing our farm. So, and they've got a good pedigree, right, in building their own tech and doing things themselves. So this just highlights to me that this growing trend of, tech and platform becoming closer together is just here to stay. And I think will accelerate. I think if this is a global theme, and I think it sort of solves two problems to an extent. So we know the tech players, they really struggle because their business model, their revenue model is pure SaaS, it's selling seats or maybe tokens in the future. But when there's only a few 100,000 advisors in America, or in our case, 15,000, we know what that looks like from a growth cap. You can only charge so much, and yet you want to spend hundreds of millions of dollars making your tech better. So I think for me, Altruist have clearly got to a point where they decided, you know what, we need a big brother. We need to grow this thing. And that's what they decided to do. And I think what it also allows a business like Vanguard to do is to look at all the different ways they charge customers, which, asset management fees and all those things. And they just have scale, right? So they can effectively use their scale to basically get better bang for buck out of research and development on the products. And the idea is that if I go and build I don't know, let's say a note taker for lack of a better example. Well, if I had 1,000 advisors, it doesn't make a lot of sense. But if I've got 5,000 advisors who kind of want that, then I can probably justify spending $5 million doing that,
Yeah.
And spending money on this. And I think the other interesting thing for me is, as the funds under management continue to grow, it does allow the custody provider to have different levers for how they charge for advice tech. At the client level, perhaps, a whole bunch of stuff I think has got to be worked through as an industry, which if you're a pure software play, has some appealing aspects to it, because I think everyone would love a business model that's tied to the client numbers and their assets rather than just advisor numbers and paying you $100 a month. I mean, that is a real constraint even we deal with in our software company.
Yeah.
So I think it's a really interesting development, and I like all these things because it'll make the other custody providers get into gear probably faster than I reckon. Yeah, competition's so good for everybody. So the only interesting thing for me is it's as I said, Vanguard's known as a very customer-centric organization, but not exactly fast-moving or innovative, and they're acquiring a business that's known for just being that.
Yeah.
So, how are the cultural things work? I don't know.
How is that? Yeah, how is that actually going to work? Are they kind of going to leave them alone to still do their own thing, or is they expected to come under one umbrella?
No, well, the message here is pretty clear. That this is kind of thing about brands, right? We were talking about this last week about when you acquire a business, like the worst thing you can do is bin the brand. Like that's often what has the most value. So they're going to keep their Altruist brand. I think they're going to keep the Hazel brand, which is well known for what it does with AI now. And apparently the management team and everyone sort of stays in place. So I think it will keep operating as a independent, not an independent, that's the wrong term, but a standalone subsidiary of Vanguard. There's probably some Chinese walls that they need to maintain as part of the deal. But obviously now they've got a huge balance sheet, and they've obviously got a huge distribution opportunity now, because there's probably, maybe I think Hazel's got 1,800 or 2,000, so 1,600 firms using Hazel. Well, there's about 10,000 firms in the US that aren't. So who would probably use Vanguard at some, everyone tends to use Vanguard for something. So I can sort of see why this is a bit of a win-win for both businesses to an extent. But obviously, advisors is going to have to come to grips with the fact that often things that they thought would be independent forever don't always stay that way for a whole bunch of good reasons.
Such a shifting landscape too, especially, with, I wonder if AI, Hazel was the kind of, the standout hook to all of this as well, given
I hope the guys who started Hazel, which was originally Time, I hope they got stock as part of their acquisition into Altruist. I'm sure they did. Yeah. So they've obviously done well if that is the case, and so they should. They're a big part of the deal. But yeah, I think it's a good point, Danny. Like if you are a wrap platform and you've successfully implemented advice tech effectively in a way that the users love, then it sort of stands to reason that external investors would see that as a more valuable asset potentially than if you were just a wrap platform alone, and probably had less defensive moats around your business as well.
Yeah.
So I would imagine deals like this would make our local players here look with interest and go, oh, okay, yep, that can see how that works. And it's interesting for shareholders in Australia and investors and pundits like us, because people don't like blank sheets of paper. So you and I have been talking about this for years now about how this issue's got to be solved, and people go, oh, yeah. But it's not until someone actually does it in another market that everyone goes, oh, okay, that makes sense now.
Yeah.
So
you never want to be the first cab off the rank, do you?
No one wants to be first, which is such a shame. But anyway, look, good on them, I think. And as I said, if the plan seems to be to retain the entire team and just keep doing what they're doing, but obviously now they don't have to worry about raising capital. And let's not forget, like anyone who runs a tech business will tell you, like it's capital intensive, and particularly in platforms where it is hard to get to compete. If your fund is whatever their fund is at the moment, Altruist, but I think it's at the 20 or 30 billion. But let's just say, for example, you're competing with $1 trillion as your nearest competitor. Very hard to compete from a scale perspective, simply.
Yeah.
But what it has done is definitely pushed the valuation. So we'll do a bit more deep diving. As I said, it's a private transaction. So the hard thing about Vanguard doing these deals is they're not public. They're a private company. So we can't get a lot of it. So all we know is it's been acquired $4.5 billion US is the total price.
Wow.
So yeah, kind of interesting.
Interesting.
All right. What do you think about? I mean, do you think this will spur? I mean, you talk to platforms all the time, right? And advice firms, do you think we're going to see more of this?
Well, I think if you look at what the platforms are doing at the moment, so Hub24 and NetWealth, they're bringing to MyHub, for example, bringing all of these things together, all of the integrations and the applications together in the one spot to make that a really good experience for the advisors. So I think we're kind of on that. We're on that journey at the moment anyway. And like you said, we don't want to be the first cab off the rank. We kind of normally follow what the UK and the US do if it makes sense. Over here in Australia as well. It's just different markets, right?
Yeah.
That we're dealing with in terms of size. But I feel really confident with the way, the bigger platforms are going at the moment with their strategies and what they're thinking.
Yeah. Yeah.
And the AI overlay, makes all the sense as well. So I watch this space.
Yeah. It does make you wonder, like we can talk about now because we're not consulting at the moment, but if you look at, I look at a business like IntelliFlow, right, who were part of a US, conglomerate. Now they've been split out to be back to their Australia, UK roots, kind of UK roots particularly. But now as a standalone company, they've got 30,000 advisors using their software, right? And there's a lot of wrap platforms in the US who are in the UK who would be desperate to have that tech tied and tied together. I just wonder, will this deal like this sort of look at SS&C or someone that has deals with these providers and say, you know what, we need to let's tie ourselves together, on that side as well. It just wouldn't surprise me to see some more action on this front. It may strengthen some of the case that Iris is trying to run, around their strategy. Like I think a lot of businesses are going to look at this globally, and a lot of the venture, big PE firms and others will go, you know what, maybe these assets are more valuable than what we thought. Because all they're going to try and do is match make advice tech player A with custody player B, put them together.
Yeah.
So I think, everyone just copies each other at the end of the day. So
yeah, and it makes sense that marriage makes a lot of sense because it's, as you very well know, it's really hard to fund yourself when you're building a tech product, and you want to grow and all of those sorts of things. So it makes a lot of sense to me.
$10,000 per advisor per year.
Someone's got to pay for that.
As Aaron says, someone's got to pay. Who pays?
Yeah.
Every time I think about something, Aaron's like, yeah, but Pete, who pays for that? I go, yeah, right, okay.
Stop being so logical.
Stop being so practical. But I think, but for me, the technology side of it's fascinating to me, because I just go, well, actually, in many ways, does it validate that whole idea that, us trying to make advice CRMs and pull in 40 data feeds and make it into this all singing, all dancing thing is maybe not where we end up longer term. When does that ever work? So has that worked? But it'll be different this time, Danny. It'll be different.
It doesn't work.
I know. It's too hard.
It's really hard.
The data is shit house. And so I think the whole idea that Altruist had with Hazel was to say, well, actually, we just sit it on top of our custody data. And because it's our tech, we're very happy to give it full access because we're not worried about security in the same way that we would an external partner, in terms of that. And it's real time live data that we're modeling client stuff on. Like you're 1,000% right. It just makes complete sense if you've got all your business with those people that you're not modeling on non-live data. Who would have thought?
I remember when we were working with IntelliFlow and helping the guys out there, we were talking to them about data feeds in Australia and how data feeds worked. And they were like, yeah, sure, that's easy enough. We do that, or we do that over here in the UK. And we were like, no, we need the transactional data as well, because they only had the portfolio valuation fields in IntelliFlow and a couple of other bits. But, we go deep in transactional data. And they were like, what? Don't you go back to the platforms for that? Like, you could.
Which was the right.
We wanted
They were right. That's the right way.
They were baffled, and rightly so. They were baffled, and it made me baffled as to why we've been doing it like this the whole time.
I think the other complexity in the UK market too is, how they call products plans over there. There's so many different plans. So every company has thousands of plans, individual products, which are, some of them must be closed-end products and different things they do. So their complexity was more the number of products they had to feed data in. But you're right, it was just balances. It wasn't superannuation, cons, and all the other crap that we pull through. So tax data particularly. So anyway,
interesting.
When I get more time, I'll write about it tonight, I think, for Code and Capital, and try to unpack it a bit more. But well done to Altruist.
Yeah, well done. Excellent. All right. Well, thank you for listening to another episode of the Wealth Tech Insider, and we'll look forward to seeing you next time.